So good afternoon, everybody, and apologies. That's okay. Oh, okay. I will get used to the microphone quickly. So thank you very much for waiting. As you probably have all experienced, it's not the easiest set of pavilions to get around, and I had to rescue a panelist before we even started. So thank you for coming to this panel on climate finance. What we're really interested in today is thinking about high interest rate environment in which we now are finding ourselves, the fact that climate finance has really been born and delivered in a low interest rate world, and think through some of the impacts, some of the players, and what we can actually do here in this room to continue scaling up climate finance in a very different set of circumstances. Before I get started, I just want to quickly introduce myself. I'm Jane Wilkinson from Apt Associates. I head our climate practice in Apt UK. I would like to start with Amal-Lee. Amal-Lee is the Managing Director and Head of Climate Diversity and Advisory at British International Investment International, formerly CDC. She was previously at IDB, E3G, and spent about 10 years in government working on sustainable energy and finance issues. Jiwoo Choi is the Chief of Strategic Initiatives at Acumen, and before that was Deputy Executive Director at GCF. Vikram, who's one of my old climate finance friends, in fact, everybody here pretty much is one of my old climate finance friends, is a Senior Advisor with Climate Policy Initiative. He worked for 25 years at IFC, and so really sort of was there at the beginning of carbon markets, at the beginning of climate finance. He's a fellow of the Atlantic Council and a Swiss Army knife of climate finance, I like to think him about. And Manuel Bueno, my colleague from Apt Associates, is the Director of Climate Finance in our US program. And prior to joining Apt, he spent about a decade doing deals in agribusiness, forestry and fisheries, particularly in emerging markets. So thank you, everybody, for agreeing to join me on this panel. I'm really excited to have you here. I think on this topic, you bring a really interesting mix of backgrounds and experience and present interest. So thank you very much. Just to sort of set the scene for everybody thinking about climate finance in this context at the UNFCCC and the 100 billion, I suppose. The numbers that get thrown around are pretty wild sometimes, and you hear about trillions, and then you hear about things like finance has risen, or it's doubled since 2010 from about 300 million to 640 billion. And it's really important to recognise that those are primary climate finance transactions. So the secondary market and the business of refinancing is vastly huger than that. And really what we need to be talking about is that whole big pot. But thinking about how we can be scaling up those primary transactions, that's what is talked about in this negotiation, really. And the fact is that climate finance has really been developed in a low interest rate world. In fact, the approaches that we have been partly driven by the fact that low interest rates have made, in a lot of places, the cost of capital quite cheap, but it's important to recognise that it's not in all places. And that climate finance, even though there has been this scale up, is still falling vastly short of what we need. Recent estimates are that we need about 4 to 5 trillion per annum to reach a net zero world. At the moment, if we're reaching about 614 billion, it's just very short. Interest rates are rising, and in emerging markets, we're already seeing falling private investment, an uptick in private distressed debt, even more constraints on public discretionary budgets, and overall economic growth is lower than it was. Much of the future growth, the low carbon, climate resilient future growth that we anticipate needs to come in these economies, needs to come from emerging markets, because that's where the emissions potential is, That's where the low carbon investments need to be made. So what I'm really hoping to sort of get to the bottom of here today is what's happening in terms of how climate financiers are actually tackling this challenge of a high interest rate world, what needs to be adjusted so that we can actually make finance flow. How can the actors here in their capacities actually, what do they need to do to support climate finance flowing? And what can we in this room and online take home and develop further? I'm going to start with Amal-Lee, and just to note, Amal-Lee may have to run out a little bit early, so I will try and ask her as many questions as possible. I just want to start actually by asking you about yesterday's report, and perhaps if you can share some top line notes with us.
Yes, thank you. So I think, first of all, I just want to congratulate you on this particular report, because I think it really picks up all the key issues that we are now facing, in addition to some of the previous challenges we've seen in really particularly mobilizing private capital into many emerging and developing economies. I've been a member of the high-level expert group, otherwise known as the Songway-Stern group, that has been looking at this issue and looking at what comes after the 100 billion. So, of course, the 100 billion per year commitment runs to 2025. There is a process here under the UNFCCC looking at what replaces that. It's a terrible name, the new collective quantified climate finance goal. I think they really needed a better name, but it slips off the tongue a bit easier. But basically a process that has been underway for a year. I actually participated in one of the technical expert dialogues earlier this year. And I think in that process, and very much in this high-level expert group that Lord Stern and Vera Songway are convening, we're really trying to take a more of a sort of understanding around, well, what are really both the needs, the challenges, and then when thinking about the private sector, the opportunities, and ultimately what's needed to really unlock those opportunities to bring in the private sector. And so the finding of that report, I think, is very similar to your own, which the time of low interest capital is over. Having said that, many of the markets we invest in, and so I probably should have said as British International Investment, we are actually the oldest DFI, Development Finance Institution, created in 1948. We were known as CDC Group, and we had, until this year, we only invested in Africa and South Asia. And I think we say it, I haven't seen this written down, but we're the biggest private equity investor in Africa, sub-Saharan Africa. So, we've been working and trying to invest in some of the hardest markets. And many of those markets, actually, the interest rates have been particularly high. I think as high as 25% in, some of the fragile conflict states, of which, there are many in Africa, unfortunately. So it's not that we've been operating in a low interest context, but of course, with the current macroeconomic situation, rising interest, inflation, all these pressures are having some very, very significant impacts in many of our markets. I think here, only, was it last week here in Egypt, I think there was a devaluation by 25%. So, it's a very difficult macroeconomic situation here. And we know that will be, there'll be a number of similar, at the country level, a lot of probably defaults happening over the course of next year as a result of, obviously, the multiple crises that countries are facing. Obviously, COVID, energy, food prices, and then in some cases, I mean, Pakistan being a typical example, climate crisis as well. So just to sort of highlight that, we already been facing a lot of these challenges, and to a certain extent having to innovate in some cases. And we do have we have what we call our growth capital, but then we have Catalyst, where we can provide more concessional funding. We do have now more sort of really concessional that could be used even in a sort of grant or first loss position, particularly for climate, to promote innovation in climate finance investments. And so I think, as we're looking at this, and just going back to the Stern Songway report, they come up with a number of that probably we need to stop thinking the 100 billion has passed. I mean, it hasn't. It still needs to be delivered. But we need to be thinking more around maybe, in the scales of the trillions. And, of course, it's impossible to put a precise number, but we need to be thinking in terms of trillions and understanding that also requires different types of finance, sort of the quality or the financial instrument that is used is going to be essential to deliver on some of the specific challenges. And in the middle income countries, that's where largely private cap, there are most middle income countries, they have fairly strong private sector markets, capital markets. There is now need to really help bring in other forms of capital. So this mobilization of institutional investors. But then at the same time, and this is something that we at BII are very focused on, we also need to be ensuring we have a strong emphasis on what I refer to as inclusive climate finance, because I think a lot of what we're hearing, why is finance not getting to adaptation? Why is it not getting to the smaller countries, the poorer countries, which of course are most vulnerable? And I think a lot of the incentives that the 100 billion drove was actually to get the big ticket items out in the big countries. And some of these smaller investments, particularly in adaptation, can be quite small ticket size. I'm sure Jiwoo will be seeing this very much as well from Acumen's perspective, but can be very, very impactful. And so, can provide adaptation services to potentially hundreds of millions of people for quite small investments. So we have an investment in India. We made a relatively small investment, $10 million that is providing adaptation services to 4 million farmers in India. So if you think how many people may be benefiting. So we need to really think differently, I think, and think more about the impact and not only about the sort of volume. But of course, the volume is going to be important.
Can I just ask you a question? Around 35% of BII's portfolio in financial services is in India and Africa, as you just said. And I just noticed that your title has got this really interesting new twist in it around inclusivity. How are vulnerable people, women, marginalised people, how are they being impacted by the squeeze?
Yeah, so we have, we traditionally, when working or investing, we've either provided sort of a general purpose equity or a general purpose loan to our financial institutions. However, in recent years, we've actually realized that where we want to have a real impact in this area, we should be focusing on more directive lending. So green lines on the climate side, gender lines, and SME lines. I mean, for me, the ideal is to hit all three of those in one go. And that's where we can bring more concessional funding, but also very importantly, where we use technical assistance. So I think when looking at working with the financial institutions, we need to help build their capabilities internally. But it also may mean working with senior management to help build their understanding of what it requires of them as a leader on this agenda. I think that's one of the things, and I think it's interesting, the Task Force on Climate-related Financial Disclosure has really highlighted the importance for ensuring there is sufficient leadership and expertise at the top level, as well as the ability to then be able to better report and disclose on these issues, which I think is starting to open up new opportunities to focus more on the opportunities. I just want to say one last point before I probably do need to rush, unfortunately. But I do think, I mean, the fiscal situation of countries is clearly severe in many countries, many cases. But I think also we need to think about in a way that puts probably even more emphasis, more pressure on the need to reduce some of those subsidies that are actually having very significant fiscal implications, but also need to be reformed. For example, fossil fuel subsidies, agriculture subsidies, subsidizing water. Now I'm not saying, I appreciate there may be some real needs to provide some targeted social support, but provide that in a targeted way. Don't just subsidize free water or other inputs to agriculture, because those are having very severe impacts at the macroeconomic level and not necessarily driving the innovation, in fact, probably disincentivizing the innovation that is needed, particularly in adaptation and resilience, which is also, I think, importantly, we need to recognize is not only about increasing the output of products, but it's more efficient, more effective use of water, of other resources. I think that's a big part of the adaptation and resilience agenda as well.
And just to flag to Vikram that I am going to come back and ask you a question about that. And Amal-Lee, thank you so much. I'm going to keep moving down the line now. But thank you and good luck in your next panel. Jiwoo, you were nodding a lot there. Acumen's focus has always really been in providing patient capital and coming into the funding gap that Amal-Lee was just alluding to. And since your inception, you've provided around 115 million in patient capital. It's a mix of equity and debt. And I was wondering, what are you needing to do to adjust the delivery of that patient capital at the moment in this high interest rate world?
I think the key is how we provide long-term financing to the innovative companies in climate space, because the market always moves. We see, actually, it was the exception that we see this low interest rate environment goes that long for about 10 years. So Acumen's focus is more, how do we provide the long-term finance, right kind of capital at the right time? So that's what we're trying to do. And that's what we're trying to do with our vision of patient capital. Maybe, can I just maybe start from what Acumen does, just to provide longer term or accompaniments that we want to call to the companies. So I'll just give maybe the example of what we do in energy sector. Acumen is actually very active in energy, agriculture, healthcare, but in energy sector, so especially the off-grid solar sector in Africa. How we started our investment was we actually invested an idea of solar lantern in 2007 with a company called Delight. So at that time, nobody had the proof points about this product or the market or the impact. But Acumen, as Acumen, decided to incubate this idea and see where we can go with this idea. So that was 2007. And then we actually invested 40 companies across this emerging off-grid sector since then. So what happened was, so this one company, so the patient capital, what it means is we actually let the company try, fail, try again, fail again, but try again, listening to the customers and just together figuring out what was the issue until they have real business model. It took about 5 to 6 years with one company. But as they figure out the business models for this particular off-grid solar sector, other companies actually followed. That actually led us investing in 40 companies along the line. And it was about 2015 when actually the product was being proven in the market and the revenues of these companies are becoming about $40 to $50 million. And that was when the companies were close to profitability. So we actually thought the impact investors, the traditional impact investors, will come to the space and scale these companies up. But there were not a lot of impact investors, even still at that stage. So that's when Acumen started to think, what about we put together more traditional impact investment funds and then scale our companies up. So that was the first time we actually worked together with Green Climate Funds and launched more traditional impact investment funds called Kawi Safi funds. Then that private equity funds together, it was $65 million fund. That fund actually helped the company scale up. So that was like 15 years of investment of Acumen. So now we look back 15 years of our investment in energy space. I think we saw a needle moved in some of the markets like Kenya. So energy access rate was 20% in 2007. Now it's 75%, and it's almost going to the universal energy access, hopefully soon. But it only happened in a few countries. So our aim is replicate the success case in other 22 countries. We understand the harder macroeconomic situations. That's why we have to put together a longer line of sight financing for the companies to have a courage to go to the high-risk countries, the like least developed countries. Like, South Sudan, there's only 1% of energy access rate. How can we encourage the companies to go to that market and build the company and ecosystem? So that's what we are trying to do. And
do you see that there will be more demand for impact capital, for patient capital, and for the sort of investing that you do, as we see large donors like BII potentially become more constrained?
Yes. DFIs and including BII is more constrained. That's actually the situation for everybody. But there's still capital available out there in the market. And then how do we align the expectation of investors and the needs of the companies? And that's what we're trying hard on it.
Thank you so much. I'm going to come back to you after I've gone right down the line. Vikram, if I can come to you first, it's not the surprise question, but just sort of drawing on the very different roles that you've been playing over the years, and now in Climate Policy Initiative, where you're really looking at what the misalignment is between policy and finance and all of those kinds of questions. The rate increase is going to impact the volumes of investment, as we've heard. What are some of the examples of options? And you can refer to the report from yesterday as well. Could you give us some examples of some of the options that are actually really on the table that we could start to put into practice to mobilise investment in this new high interest rate environment?
Hello, I think we are gone.
Oh, yeah.
Swap. I can swap. This works, right? Of course it does. I'm not pivoting, but I'm going to take the liberty of providing some context. One of the things, and inflation is just another challenge that is imposed in the context of climate finance. The problem with climate finance really is that it is expected to solve for all that ails development finance. Traditional development finance and we are here, we are worrying about inflation, we are worrying about forex risk, we are worrying about political risk. All these are not relevant necessarily to just climate change. But the imperative has become such that we are long past worrying about just poverty reduction or development assistance. We can come back later to what that means for ODA and other things. But to set the context, I want to just quote a couple of people who are better position than I am to make these kind of statements. A senior emerging market-oriented fund manager at Climate Week said, and I think the numbers bear out, that 10% of the world's investable wealth needs to be invested in the next 10 years. Most of it has to be in emerging markets, and leave alone emerging markets, this has never been done before. The Nigerian environment minister at SE for All event on Monday said that less than 2% of global renewable energy investment is in Africa, because they're in Africa. Inflation may have already made this statistic redundant, but the average African sovereign borrowing was higher than 16%, whereas the same countries can borrow from the World Bank or other relevant NDBs at 3%, except that, of course, those are limited pools of capital that they can do. So what am I trying to sort of do by pointing these things out? The whole problem, exacerbated by inflation, is what the delivered cost of capital is, and on the ground. We are talking about projects that are very good, but not considered bankable for those hundreds of billions of dollars in global savings that claim to be on the sidelines, just waiting to move in. And that's not just going to happen on its own. A forthcoming analysis, which we have just done for the International Solar Alliance as CPI, is showing that if you look at the whole cascade of risks, right from macroeconomics to solar, countries like the US and Germany need an 8 to 10% return, whereas most of the emerging markets, with some exceptions, are in the 20 to 30% and some even higher. How are you going to create that kind of return for investors? Because that, unless you address some of the key risks that add to this sort of cascade, if you will, of building up the cost of capital. So I finally might come down to answering your question directly. Okay, fair enough, right. So we got to reduce the risk, we got to manage it, we got to share it. And I think we have to look at non-traditional ways of doing this. I don't think we can continue to rely on the market to provide long-term 10, 15-year forex hedges for the Nigerian, Naira, even if it's available for the Egyptian pound. It's just cost prohibitive. You can, the TCX has done a wonderful job. TCX, for those of you who don't know, is the currency exchange. It was set up by IFC, my prior employer, and many other NBBs to help exactly do that. But it's very expensive. Political risk from MEGA is available, but it's available at a price that also, while it's an MPB, is affordable, it's got capacity issues. There's policy risk, there's enabling environment. So there are certain things sovereigns need to do themselves. There's no doubt about it, And perhaps as the Songway Stern report starts to imply, which is the one that Amal-Lee is on the expert group, and as was my colleague Barbara, is saying that we need to look at it differently. Is it possible, and I'm extending the report doesn't say this yet, could FX be actually dealt at the sovereign level? On the other hand, even if sovereigns could technically manage the macro risks that cause currencies to fluctuate, a rising inflation environment, strengthening dollar with no regard to individual country level macroeconomics remains a challenge. So we really need to be looking at how the GCFs of the world can be capitalized at a much higher sort of quantum. How can donors start to look at more creative ways of addressing this? And my argument is, and I'll end with these 2 points. One is we need to be looking at solving these risks on a wholesale basis, not retail. We cannot be doing project by project. Every solar developer cannot go to 8 windows to try and get these risks addressed, even if they were addressable. So can we look at regional, at least, if not global solutions that can help with some of these risks, including offtake and credit risk? And one of the things that we are proposing is that some of the credit risks could be sort of addressed by creating a guarantee that is only partially capitalized by donors and has callable capital associated with it. That allows for a lot more capital to become available and yet not appear on the balance sheets of donors. And if you don't believe me, just look at the World Bank. That's how they operate. Most of the World Bank is based around callable capital. And I'm not saying we create a World Bank level institution, but that. And the second thing, now that I mentioned the World Bank, is that MDBs, like EBRD, IFC, IDB's private sector affiliate, are organizations that can originate and de-risk in a way that can help create volume, allowing for that to be distributed to investors. Investors look favorably on the record of MDBs. Can we leverage the MDBs even more? Give them more capital, have them do more of, they originate to hold most of them. They syndicate some, they need to do a lot better job. They need to be given the mandate to be able to underwrite much bigger pools and deploy much bigger pools of capital that are backed by institutional investors. We can explore any of that or more. Thank you.
Thank you. Manuel, sorry, I will come back. I will just give Manuel a chance to speak. Manuel was the author of the paper that has sort of given rise to this panel today. So, Manuel, thank you.
And I forgot to congratulate you all on that. That's well done. Thank you.
And we often spend quite a bit of time talking during our working week about climate finance and what some of the potential solutions are. And I think one of the things that we've discussed a bit lately has actually been the immediate impacts that we can see in the market around not just the cost of capital, but what's actually happening to existing debt. And we can see that there is this big uptick in distressed debt. And so I was wondering if you could talk a little about that and perhaps about some of the solutions. Why has distressed debt become really such a thing right now? And what can we do to really support climate financiers and developing countries and private sectors who have distressed debts to really restructure and move forward?
Yep. So I'll try to keep it brief because I'd love to go around and like have a little bit of a debate. But key point is increasing interest rates globally has resulted in an increased amount of distressed debt from particularly vulnerable borrowers that are coming out of COVID in a very tricky situation, inflation on top of that, particularly in rural areas, farming communities, the impact of climate change. It's just happening all over the place, right? So this uptick in distressed debt, in some cases, right now, it's starting to bubble up. Either formally or informally, a lot of the conversations that I've had with friends and family in investment banks, in impact investment funds, in banks, microfinance institutions, it's for the time being slightly subdued in that, you don't ask about it in a boardroom because it's kind of impolite. You grab a beer, you grab coffee, how's the kids, how's the family? Oh, by the way, how's your part 30? And they say, oh, geez, that's giving me a little bit of a sleepless nights. One of the ideas that we're exploring is how to help restructure that debt, which would be great, and connect it with certain climate outcomes, right? So it's about the debt restructuring and debt restructuring to climate-linked debt. Technically, this is not hard. Technically, this has been done a lot of times. We're not proposing anything that is particularly creative. It's identifying the reason why those borrowers are in default or late in payments, trying to figure out what is the solution for that. Sometimes it's an exogenous sort of shock, restructuring that debt, moratorium in certain payments, technical assistance, capacity building. It involves potentially the lender taking a little bit of a haircut, taking a little bit of a loss. Then technical assistance and including climate-related covenants on the new debt. So It's not only about saying, hey, you know what, we're going to give you 12 more months to pay your debt, but rather we're going to give you 12 more months, maybe a little bit of liquidity, a little bit more cash, so that you have a little bit more money for the next harvest, so you can prepare and buy those inputs, so you can adopt climate smart practices, and we'll give you technical assistance for that, right? And you in exchange, you as the borrower, you accept additional climate-related covenants, right, in terms of your adoption of climate smart practices. So technically, it's not hard. I think that the hardest thing, candidly, is the emotional component of it all, right? Lenders do not want to talk about until it's truly obvious about. They don't want to talk about their distressed debt. It's just one of the things that you avoid until it's impossible to avoid, essentially. And it's a very tough conversation for borrowers. I mean, it's like, let's just not forget, like, people commit suicide because they are defaulting on their debt, right? So it's like, for me, the key challenge is less technical and more of a challenge of, let's make sure we're respectful, let's make sure we're kind, let's make sure we have a lot of empathy in engaging both lenders and borrowers to do that. We've started talking with some second-level funders, the investors on those banks, the financial institutions that provide funding to microfinance institutions. So at that second level, and saying, hey, how can we approach this with that sort of kindness and that empathy? And very importantly, there's also an inclusive challenge here, because when you choose to restructure debt, you're not going to restructure all of that debt. You have a lot of power in terms of saying, look, this business will survive for 12 more months because we're going to give them that additional sort of lifeline in terms of credit, and this one won't. Like, this one, sorry, but this one is beyond saving. Typically, when people make that choice, businesses that belong to marginalized communities, they tend to get the short end of the stick. So it's super important to keep an eye on making sure that marginalized communities do not get that short end of the stick when restructuring that debt. But we started talking internally, we started talking with some of our friends in those financial institutions about designing and capitalizing climate debt restructuring facility. And I'll stop here. You probably get the sense that I could be talking about this for hours, but this is one of the ideas where we can really make a difference. We can really bring in a lot of donors interested as well in supporting within a blended capital facility some of these solutions as well, right? So it's not only about the DFIs and the market investors, but bringing the donors in that way as well.
Thanks, Manuel. So the question that I actually was originally going to ask Vikram, I'm going to ask out, and I'd really love it if you could respond as well, Jiwoo. And it goes to points that you've all raised around marginalisation, the fact that already, particularly MDBs, are pivoting a little bit, that TA is needed to help to build capacity in banks, financial institutions, etc. Vikram, I really wanted to pick up on the point you made about the sovereigns need to do more themselves. And so I wanted to ask, in terms of impact investing, what do you need more from sovereigns to actually make impact investing go further so that it's actually filling a gap that cannot be filled by an MDB?
Yeah. So from the government, definitely in order for the private sector to grow in the market, the regulation has to be there. So that's the part where we work together with the government, and especially for Acumen. All we do is to make sure the low-income community in low-income country do not get left behind. Because in this scarce capital situation, those marginalized community, the low-income community, low-income countries who have contributed the least to the climate change are getting the hardest hits by climate change. So that's where we try to come in and support. And we actually talked about, Vikram and Manuel talked about how can we be more innovative in this time of difficulty. And what we're trying to do right now as Acumen is we are putting together impact indexed loans. So the scarce concessionality only goes to the impact created by the companies. So that's the product that we are rolling out. But how do we, especially in this high interest rate environment, how do we get funding for us to do it? Then we are actually putting together 8 debt funds, a blended finance structure. So GCF and concessional climate financier providing the first loss capital, which will give the senior investors like better return and better protection, so that we actually mobilize like more funding than maybe through 1 or 2 groups of capital. So we are trying to mobilize the capital who has different types of risk appetites into one part of the pool. And then we have very clear mandates to create the impact with the concessionality getting from them. So that's what we're trying to do.
Thank you. So Vikram, building on that, we still see a lot of plain vanilla finance in our markets. And so we can't exactly be critical about the fact that banks might have difficulties, or commercial institutions in emerging markets, to sort of pivot around this as well. What actually how can sovereigns be building the policies they need to, for example, create this aggregated market?
So I think sovereigns, it's a much used phrase, but I can't but help use it again. The enabling environment, it's critical, whether it's through supporting them through technical assistance or capacity building, but repeatedly the price of capital goes up because it needs the ability to navigate complexity, worry about legal frameworks, contractual enforcement. This is all in addition to all the other good stuff that we've already talked about, right? So that enabling environment is going to help a lot. And this comes back to your earlier point, right? What do we need from sovereigns? What is sort of their ability to function? Things like off-taker credit risk. Solar is financed on razor-thin sort of ability to service debt. The minute a off-taker, usually government-owned, doesn't pay them, they'll pay them. It's not a question of not being paid, but it's a question of being paid immediately. If you get paid 6 months later, somebody else better be taking that risk and making sure your debt doesn't go unserviced, because the cost is already pretty high. And if all that goes out of whack, forget about solar remaining competitive with coal. And so countries realize that, but they, I think, need help. And I'll also add, if you may allow me, a remark on the donor side of sovereigns, right? Donors have to start internalizing the fact that this is no longer a nice to have. This is a must have, unlike unaddressed poverty, which was the development mandate for ODA. This thing is going to come bite them too. Climate risk is not, what is happening in Pakistan, what has happened in the the floods got us attention. The whole extreme heat issue from London to San Francisco, everybody's baking from everywhere. This is going to come back. This is going to be long term. I have to realize that. So how do we also have them help align, or they themselves as a club align ODA, climate finance in a way that allows them to be much more forward-looking and flexible, and support the countries who definitely, the recipient countries, who definitely need a lot of help and need to put in effort to get their act together. So,
thank you.
Did that help?
Yes.
Okay.
We have a solution now. Manuel, you used the word empathy, which I thought was a really interesting word to hear in the context of a finance conversation, really. But I personally think you're absolutely right. How do we actually build up the groundswell from the donors, because I think, this climate finance negotiation has been so finger pointing for a long time. And now we're in an environment where the $100 billion still hasn't been met. We're not even going to talk about climate finance anymore. We're going to talk about finance, which I also agree with. But how do we build in the empathy so that people can see that it's not about moving sideways. It's actually about wrapping your arms around something and making it bigger. What solutions do we have for donors and for sovereigns? Your idea around the technical assistance fund, for example.
Yeah, it's a very hard question, right? Because lenders do what they do. They give out loans, they get their money back, they make a profit, and often their profit is managing operational expenses. Like go to a bank, and those are the key. There's 2 or 3 key, very strong financial KPIs, right? So I think I talk about empathy a lot because I think what I've seen a lot as an investment professional on the ground, what I've seen a lot with loan officers is that you don't do good deals if you don't know the community that you're investing in. You don't do like the moment you go above $5 million, that's fine. You can afford to be a little bit more of a formal sort of hands-off lender. But the moment you're going beyond like the $1 to $2 million or even less, in emerging markets, a big chunk of the risk management of an investment is, can I trust senior management? When you give them a handshake, do you know that they will pay? Because at the end of the day, it's cash flow lending, not balance sheet lending, and it's the collateral is not going to be worth much. You know that you can take them to court and you're not going to get your money back anyhow. So empathy means to me, and the way I train my own investment staff is you're an ally to the business. You're a partner to the business, and you sweat it out with them. And so when things go well, you all party, and when things go bad, you get under the tent and you do what it takes to get the business going. And often that means calling buyers and say, hey, do you want to buy the products that my investee sells? That's my first reaction. I think there's trying to understand like truly the needs of the borrower, of the investee are very, very important. Like I'm seeing more and more demand for very, very basic insurance solutions and cheap, because insurance is not cheap at all, unfortunately. And it's really trying to design a package that meets the needs of the borrower, not so the borrower rather than the lender, rather than the investors. And I say this knowing that that's easier said than done, right? Like at the end of the day, you want to try to meet everyone's needs. But in my mind, empathy begins in really understanding your end customer, and how are you going to be as a lender? How are you going to help them really drive themselves out of poverty, while also being mindful that finance is just one tool in a bigger toolkit. And Vikram, you said it really great. Like climate finance is trying to resolve all development finance kind of problems. And eventually, I find situations where we're pushed to figure out all development problems. And it's also like be mindful of the limitations of finance in pushing for many of these solutions, right? And how, a lender is a lender at the end of the day. An investor is an investor at the end of the day. So anyhow.
Excuse me.
I was just going to add to this whole empathy. I like that.
Me too. I was actually just going to say, because I'm going to, absolutely. But I'm going to ask you to wrap up with that. So I was going to say, if everybody could just sort of say a final word. Okay. Yes, absolutely.
I'd say empathy is, I think, goes beyond lending. It goes to that point of donor and host country engagement I talked about. And I'll just end on a potentially negative example. During this whole discussion on phasing out coal, the whole idea of just transition is providing alternative livelihoods. And the donor government asking is actually funding alternative training for alternative livelihoods could count as climate finance unless it was only designed to go to renewables. That's not empathy. That distinction between how you're going to deliver the final outcome versus what immediately impacts the climate has to blur a lot more.
Jiwoo.
So I probably want to repeat the empathy because I think in a different perspective, markets and the companies and the end consumers, I think those who have been getting the funding are getting the funding. And then that's something that has to be changed. And then, so that's why we try to, and then impact investment capital. My biggest criticism for it, even though I'm one of them, we are one of them, is the capital goes to where the market and products are actually proved. And then not much of impact investment capital goes to where it should be, where the funding is the most needed. At this point of time, in this difficult financial markets, I think we have to channel the funding towards where the financing is most needed, and then we have to join forces to make that happen.
Thank you. And I was just thinking the empathy point for me really aligned with the enabling point. We've said enabling environment so many times, we've forgotten what it actually means. And in fact, an enabling environment has to be empathetic, but it has to be universally empathetic. Manuel, can I ask you just if you'd like to make a final closing remark?
I don't really have anything else to say. This was great. I honestly, I mean, I love the fact that that you guys all joined this panel. And my hope is that many of these practical solutions will be picked by people and we'll be able to drive them forward, right? Like I really appreciate that we're all talking here about practical financial products that we can push forward, sovereigns, banks, with those investors in those banks, and we really truly try to move them forward, right? Like that's what Jen and I, as we started talking about putting together this panel, that's where we started. Like, how can we go beyond? Oh, there is a gap. Oh, bummer, there's a gap. Well, what are we going to do about it? Well, innovation, and then we stop there. No, let's be super practical about what that means. So anyhow.
Thank you to everybody who's here. I'll wrap up now. Thank you, Manuel. Thank you, Vikram. Thank you, Jiwoo, and Amal-Lee in her absence. And I think the thing that I take out here is, as it has been known for a while now, there's many players here. We need to be playing our part. But I am going to say, if you hear about empathetic approaches to climate finance in the future, you heard it here first. Thank you.
Thank you, Jay.